joining us on Business Tech on Channel C. I'm your host, Rick Schatzman. Recently, the economic slowdown in the US and Europe has made headlines, and China has not been immune. Decreased demand in the West translates into decreased exports from China. With us today is Howard Jiang. He's a partner at Troutman Sanders, and we're going to discuss the implications this has for China. How can the Chinese government keep growth strong? Thank you for joining us today, Howard.
Hi, Rick.
What options does China have for keeping the economy growing strong enough? For example, the latest GDP growth for the last quarter was 8.1%, correct? So, and I think it needs to stay above 6 or 7% in order to maintain sufficient growth for new entrants into the market.
In the past, the common known data benchmark was 8%, and this is the first time this year that the State Council lowered their target to 7.5. The expectation in the market is that it's going to bottom out, I think, towards the third quarter this year. That means it may have the tendency of going even further down, below 8.2 or 8.1 this year. Responding to your question on what are the drivers, how can the Chinese government keep the economy strong and going? In the past, there are a few drivers in the Chinese economy. One of them is investment. The second largest driver is export. The third one is a diminishing one, is the internal consumption, consumer spending. Faced with the global slowdown, and particularly the recession and very slow growth prospect in the US, two major customers of China's exports, I think the Chinese export machine may not be able to run at full steam. So the importance attached to the export engine driver will be reduced. Therefore, the other two drivers will have to be front-loaded, right? One is the investment, and a lot of people are saying China should be quickly becoming a consumer-driven economy. And my view on this is, I think the investment part, the driver, will continue to play a pivotal role. It's not a matter of choice for China. China is a still developing country with a lot of infrastructural deficiencies. And for China to reach a higher level, commonly existing in the developed world, China still has a long way to go. This is one reason. It's an objective need for infrastructure build-out. And the other one is the addiction to the infrastructure mechanism as a stimulus for the economy. It's the easiest tool in the toolbox of Chinese government. Each time they put forward a plan and budget money for it, you will see the impact on the economy right away. While Chinese consumers are getting richer, however, you cannot bootstrap them from spending nothing to spending all of their savings. There are a lot of things that goes towards that result. You have to have a social safety network, and you have to have people earning enough money to spend. So that is a much longer process than infrastructure investment-driven the driving force of the economy.
But the last round of fiscal stimulation in 2008-2009, there was a lot of infrastructure projects, and they worked, but they also created a lot of inflation, which was negative. Yeah. How can they do it this time around without having a repeat?
I think the last time the problem was too much, too quick. I think according to a lot of economics analysis, China's stimulus compared, on the purchasing power parity and compared to other major economies, maybe one of the largest stimulus in human economic history. About $600 billion US. Well, US stimulus was about 800 billion, but it's from different bases, right? If you factor it into purchasing power, it's clearly the largest stimulus. So it was very much rushed, And you cannot go back and look back and with the 2020 hindsight saying, okay, they shouldn't have done this, they shouldn't have done that. I think it was appropriate at the time. But looking back, could it have been better tailored, measured? Yes, I think this is what they are taking, the approach they are taking this time. It's a much measured approach, both in implementation, in disbursement of funds, but also in the budgeting and the planning process. So it's not like a floodgate gushing into the market, flood the market with liquidity, which they had spent the last 2 years trying to cool down. That was the collateral byproduct of the last stimulus.
Okay, the banks have reduced interest rates.
And also reserve issues. The reserve issues, I think it went very high, unprecedented in human banking history. You know, you put 25% or up towards 28% as reserve ratio. And every $28 from $100 deposits you receive is not allowed to be lent or spent. It has to be kept on the balance sheet. That was rather draconian. It was a severe effort to cool down the economy. So that has been reduced, and the interest rate has been cut too. So given the current level of Chinese interest rate, I think they still have room to cut further. Both in the U.S. and Europe, where in the U.S. and Japan, we're having zero interest rate, effectively a negative interest rate, right? Nominally zero. When the central bank's lending window rate is concerned. Europe, they have 1%. China's interest rate, I think the central banks more than 6%. So they still have a long way to go if need to be.
What steps can they take to encourage consumers to start spending, or at least change the mentality slowly over many years?
I think that's. I think, as I said, it's a much longer process. Even though the Chinese government clearly tried to bootstrap it. In many regions, I think across the country largely, the minimum wage has been increasing, I think around 15 to 20% a year for the last 3 years. The issue is whether the intention is clear, right? You want your economy to be a consumer-driven economy. You want people to spend more and live a better life. The issue is, number one, can you quickly bootstrap your large portion of your population to become spenders by constantly increasing your minimum wage? Are you going to kill the golden goose, so to speak? You increase it so much so the employers throw up their hands saying, what the heck, I'm not going to employ people anymore. Right. I cannot afford this. Right. So the government cannot put all the burden on employers to foster a consumer economy. On one hand. On the other hand, people's spending habit. I have two comments on that. One is the lack of social safety network. Are you the Medicare, the retirement entitlement, all those things? They are far away from developed countries. As a result, giving people a lot of incentives to continue to save. Okay, but also on the other hand, I think that's a much longer problem. If Chinese consumers become just like the West, spend everything or borrow or go into negative savings, is that good for sustainable economic growth? So I don't think China has reached that level yet, far from it. But all these factors will have to be considered. Bootstrapping a society into a spend a lot society is not easy, number one, and it's not that quickly done.
Mm-hmm. How about there have been some issues with capital markets, creating and destruction of capital. Would you like to explain a little more what your opinion is and how that?
Yeah, the Chinese capital market is a very strange market, to say the least. If you look at it pre the collapse, okay, the Chinese market was somewhere around 6,000, the index, Shanghai Stock Exchange Index, and now it is 2,300. This is the worst performing capital market in the world for the fastest growing major economy. Something is clearly wrong. what is going on. I think there are a few issues with the Chinese stock capital market. Number one, the integrity, the transparency, and the regulation of the market is far from perfect. It's not effective compared to other major developed capital markets, number one. Number two, the artificial depressed price level, I think, which may, in a sense, reflects the deficiencies that I just mentioned, created a lot of problem for investors, both retail investors, people who have savings, who want to make money on the market, but also for institutional investors, and also for companies to raise money on the capital market. So much so, the Chinese capital market has been really a champion in the world for value and wealth destruction, compared to other well-functioning capital markets that are actually, their data on it. The data on it is basically adding on 1 to 1.6 percentage points to the GDP level. China's capital market is a drag on the GDP instead of additive factor to the economic growth. They have to really focus on it to really turn the market into a market of integrity, transparency, and effective control, and allow more free market forces to play.
Thank you, Howard. We're out of time for today. It's been a great show. And I'd like to thank once again Howard Jiang. He's a partner at Troutman Sanders, and I thank you for joining us. I hope to see you again next time.